Thank you, Steve. Good afternoon, everyone. It is a pleasure to host the Q4FY20 conference call for Page Industries. We have with us today from the management, Mr. Vejji Tikku, Executive Director and CEO, and Mr. Chandrasekhar, Chief Financial Officer. With this, I would like to hand the call over to Mr. Tikku for his opening remarks. Over to you, sir.
Thank you, Ismail. And good afternoon to everybody on the call. I'm here to update you about our Q4 earnings. Revenue for the Q4, we had a decline of around 11%, 10.95 to be precise. And we had an overall growth of 3.27% for the financial year. Volume declined by 3.22% for the financial year and 18.75% for Q4. Volume growth has been affected in Q4 partly due to the COVID impact resulting in shutdown of malls and general trade. Though we had many orders in hand, we could not bill and dispatch due to the closure of a warehouse during the lockdown. For the general outlook for the market, we remain positive for the future and will continue to invest in resources, channel partners, and in technology based on emerging trends. On the marketing front, our brand effort continues with more focus on online and point of sale, which is the demand of the situation. We are focusing on increased opportunities in the leisure wear business, which has come up due to work from home reasons, and of course the e-commerce, which consumers are preferring post lockdown. On the capacity planning, we still remain bullish on that side. To support our long-term growth plans, we continue to be optimistic and are working towards our goal of doubling the manufacturing capacity in next 4 to 5 years from 260 million pieces at present. Regarding the product and the focus on categories in the financial year 21, we'll continue our focused approach on our core businesses of men's innerwear, women's innerwear, athleisure for both men and women, and jockey juniors, socks and towel, and of course swimwear. The junior business, which has been given a special focus during the financial year 20, showed us some encouraging trends and the good customer acceptance and feedback. We have a clear sales and marketing strategy for the jockey juniors, which I've already discussed even last time, with an independent sales team across the country to create a focus on the business. We are very bullish about this business even as of now. With this, I will now hand over to our CFO, Mr. Chandrasekhar, to take you through the financials of the year.
Thank you very much, Vejji. Again, good afternoon and welcome to the Page Industries call for Q4. The FY20 revenues clocked at 29,454 million, which is a growth of 3.27%. The FY20 full year PAT is 3,432 million, which is about 11% of the revenues, but there is a degrowth of about 12.87%. The gross profit after direct labor and direct factory overhead is around 39%, which is in line with all the previous quarters and previous years. So the gross margin has remained steady across the years, but the PAT degrowth is due to loss of opportunity during the lockdown, resulting due to the lower sales in Q4. Else, I think we would have been close to nearly a double-digit top-line growth as well as PAT. Going forward, in terms of our FY21, we have strong cost control mechanisms, and we have improved upon many of the systems to ensure that we run well on the cash flow as well as on the profitability. Q4 revenues have stayed at 5,413 million, which is a decline of about 11%. The Q4 net profit is at 310 million, which is a decline of around 59%. And the lower sales in Q4, we missed a lot of sales in the latter half of Q4, has resulted in the lower PAT in Q4. So I think we can move over to the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, please limit your questions to 2 per participant. Should you have any follow-up, request you to rejoin the queue, please. A reminder to the participants, anyone who wishes to ask a question may press star and one. The first question is from the line of Aditya Soman from Goldman Sachs. Please go ahead.
Good afternoon, and hope you're all safe in this tough environment. Firstly, in terms of just what's happened in Q1 so far, so I think your presentation talks about a large number of stores now being open mid-June. But can you just walk us through how the trajectory played out in April, May, so that we can estimate sort of the volumes better? And secondly, you also indicated that online contribution has increased and could potentially rise in the current environment with people sort of shunning going out and into the markets. So what is the online contribution as of 4Q, and what are the trends that we are seeing since the reopen?
So hi Aditya. Yeah, so you have first question about the existing quarter. Since I cannot talk much about quarter one in this call, we are racing to the quarter four. But all I can tell you is that the current situation is way better than we had expected. I don't want to talk because it can become futuristic. But coming to your other question of the outerwear sales vis-a-vis the innerwear sales, yes, there's been a huge swing on the contribution of the athleisure sale, which was the loungewear business for us. And we have seen almost 7% change in the swing towards the outerwear in this last quarter. So that's a very positive sign, and we are all geared up, and we have good enough stocks to cater to the market at present. And also all our production facilities are up ready, and so we have almost 85% of our people who are on board, and all our manufacturing facilities are running at 85% while I'm talking to you. So we are equipped to cater to the market. The other part being the e-commerce. Yes, there's again a huge swing towards the e-commerce side. Just to give you a basic understanding, from almost 4% last year while we closed the year, which was our contribution of e-commerce business, it's upwards of, it's in double digits now as a percentage contribution to our sale. So there's a huge swing on the e-commerce side.
No, understand. Very clear. And just in terms of e-commerce now, does that sort of level the playing field to an extent between you and the competition? Because one of the big advantages for Jockey was the significantly stronger distribution reach. So through e-commerce, could one argue that the competitive intensity could be higher, or you don't see that?
No, it's not that we do see that, but the thing is, we also have to keep in mind that eventually, whether you are online or offline, there has to be a brand and there has to be a brand pull, right? So that's always going to be play an important role when you go online. Online doesn't mean that anything can sell online. So when it comes to different verticals, we have equal amount of focus on both sides of the business. While yes, there's a surge in the on the online side at this point of time, but that doesn't mean that offline business is not working. In fact, we have got some very encouraging results of the offline business. The brick and mortar business is strong, and it's only getting stronger even in these times.
Fair enough. And just one last question. In terms of, you indicated that Jockey Junior had very encouraging sort of trends in FY20. Could you give us some numbers around what the size of the business is and what the contribution to the overall sales?
Yeah. So the contribution is still pretty small. Obviously, we just started last year, in full strength. But the good news is that this business grew by close to around 58% year on year during the last year. And we were actually sowing the seeds last year. Unfortunately, this COVID came in. Otherwise, we were in a very strong position to take off this year. Having said that, also because of the fact that a lot of regional players and a lot of smaller brands, supply chains have been hit in this period, and that has given us an advantage. And we have been able to place Jockey Junior in many new stores. We opened close to around 250 new stores during this just 1 month of presence in this quarter. So that's a very encouraging sign for the junior business.
Okay. Any number you want to share on the total contribution?
So no, as I said, it's still very small. It's sub 2%.
Fair enough. Thanks. I'll come back in the queue.
Thank you. A reminder to the participants, please limit your questions to 2 per participant. The next question is from the line of Jeetu Punjabi from EM Capital Advisors. Please go ahead.
Yeah, hi. I've got 2 questions. One, if you look out 6 or 9 months from now, do you think any parts of the business will be structurally different from where it is today? And second, second is in this path to normalization, what is the biggest challenge that you kind of expecting in terms of, is it demand, is it distribution breakdown, is it raw material issues, or just a little bit on that as well? Thank you.
Sure. So yes, so it's obviously it's not these are not the best of the times. We are working on various fronts at this point of time, whether it's a supply chain, the whole distribution piece. But the good news is that, as I said, even earlier to the previous question, the response from the retail has been overwhelming, in the sense, while we had done certain scenarios at our end, and we had obviously sort of a pessimistic scenario, an optimistic, and a mid scenario. It has surpassed all our scenarios. The response once it opened up. In fact, one of the best things which happened to the brand was the EBOs, the jockey-owned stores, and we had an overwhelming response to these stores when we opened. We have already opened close to 83% of our stores are open as of now while we are talking. Out of the 760 odd stores, we have 680 stores which are already up and running, and especially in all the metros wherever except Mumbai and Chennai, our stores actually, the EBOs did actually the numbers were more than pre-COVID era as an average daily sale. It was a very remarkable number. So having said that, of course things are going to change. We are looking at all fronts, as I said, whether it is distribution, supply chain, and of course manufacturing and operations, because you also need to have your workers with you working. And fortunately, we as a company took some very strong calls. We continued to see that all our employees are taken care. We saw that all the salaries are paid in full, even during the closed months of April and May. That helped us to get all the people back as soon as we stored. They were actually waiting for us to open, and most of the people have been extremely happy to come back to work. And as I said, we have 85% because our estimates were quite below what actually happened. So we are going full hog, and we are pretty sure that if this continues as is and it doesn't go downhill from here in terms of any new wave, we should be good to go. And 6 to 9 months it will take for us to be back where we were last year.
Okay. Thank you very much.
Thank you. The next question is from the line of Karthik S. from Fidelity. Please go ahead. Mr. Karthik, your line is in talk mode. Kindly go ahead with your question. Karthik, if you have muted yourself from the handset, kindly unmute yourself, please. As there is no reply from the current participant, we move to the next question from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
You mentioned that there was a loss of sales, and I couldn't really hear that clearly. And said that impacted, but for that, the bottom line also would have grown at a double-digit number. Casey, can you repeat those data points again?
So we had estimates given in Monday, and based on the thanks for dialing in and the question. YTD Q3 we were heading at 7.5% year-on-year growth. You know that, and Q4 was being strong. But somewhere in because of this COVID situation, even before the lockdown, the demand sort of fell through. We couldn't deliver, and there is also a significant portion of undelivered sales, which we did make in Q4, but it will appear in Q1. So we were heading towards a scenario which would have at least taken us fairly close to that double-digit top-line growth. But of course, the PAT would not have been as good because we had investments in the junior sales. We had investments in IT and technology this year. But it would have certainly better absorbed the costs if we had top-line growth.
So if COVID interruption was not to occur in March quarter, what the top line and bottom line would have looked like?
Top line would have been different by in the region of about 150 crores higher. I mean, these are estimates, but again, that all depends upon meeting those estimates.
Right.
And
yeah. Bottom line?
Bottom line would have been definitely better than previous year, though not significantly.
Would have been higher than fourth quarter last year?
Definitely, yes. It would not have been higher. The last year was like 750. It would not have definitely been higher than last year, but it would have taken us beyond the FY19 as a whole.
Yeah.
No, I'm confused. Can you explain that clearly? I couldn't understand properly.
In the last year, we had 749, right?
749 million, you mean?
Yeah. We had 750 million PAT last year, Q4, and full year was about 3,940 PAT. And we definitely would have been pretty close to that kind of PAT in Q4 this year, as well as full year. It would have reached pretty close to that number, the full year number of last year. Again, these are.
Casey, can I come in here, Mr. Bharat?
Yeah.
With G here. No, if I can answer that, though this is something which we wished could have happened, and we were all aligned to this fact that we already had orders in hand, and some we built and we couldn't dispatch. If I take a total of those, the ones we couldn't dispatch, which was almost 90 odd crores, which we had built, but it got stuck in transport and it never reached. And now obviously it will be realized only in the Q1, and plus the orders which we could not bill. If we had done that, we actually would have a positive PAT rather than having minus 12%, 12.9% PAT. We actually would have a positive PAT by around 1.5%, 2%. That would have been the bottom line if we had actually gone through the whole process of billing whatever we had in hand and dispatching or delivering what we had dispatched.
Okay, now I understand better. So what you are saying is that if based on the billing but not dispatch, or billing that you couldn't do, if that was to be done, profit after tax for the last year was 393 crores. That might have been about a couple of percentage points higher, say close to 400 crores.
Exactly. That's what you understand. That's right.
So, yeah, I think that's a lot clearer now. Secondly,
Mr. Shah?
just one sec. This question is completed. I asked the first question. Let me finish the second one. What you built but couldn't dispatch, and what you may have built otherwise, all I suppose would spill over now in the current quarter and after.
Yes, of course.
So it won't be lost sales in a sense of a forever nature.
No, not at all, because the ones which was built, which was, as I said, almost 90 plus crores, which will actually show up, and because it was some was dispatched, some had not been dispatched by the time the lockdown happened, and a lot of it got stuck on the way and reached the people only after lockdown was open. So that all got realized eventually, but it will show in Q1 now.
Okay, thank you.
Thank you.
I'll come back later.
Thank you. The next question is from the line of Karthik Sankaran from Fidelity. Please go ahead.
Hi. Thank you for your time. I had two questions. I'm not sure if they were asked previously as I was disconnected. The first one is just on competitive intensity, how it has changed, recently, and secondly, just on inventory levels within the mom and pop distribution channel.
So, Karthik, I don't know, where you got disconnected. I had answered this in a part earlier. So the supply chain, the supply chain sort of it did almost for 45 days. Obviously, we didn't supply anything close to 45 days from Page. So there was a disruption in the supply chain. But luckily, once the lockdown opened, we had some pretty good response through all the channels, whether it was our own EBOs, the multi-brand stores. So there has been a certain amount of buying as soon as we started, especially in our EBOs. It was exceptionally good. As I said earlier, there were many stores who actually did better than the last year as an average per day. Pre-COVID and post-COVID era. So now I think things are pretty much in shape. I don't want to talk too much about this because I also don't want to talk futuristic. But all I can say is, it's above our expectations. What's happening now. And coming on your first part, which was the competition part, I think it still remains the same. Everybody is trying to do their best, as are we. So I don't see any change in that side. Of course, we definitely will have an advantage in terms of supply chain because manufacturing under our control. We should be in a good position to supply whatever is asked from us.
Thank you.
You're welcome.
Thank you. The next question is from the line of Bhargav Buddhadev from Kotak Mutual Fund. Please go ahead.
Yeah, can you hear me?
Yes, we can, Bhargav.
Good afternoon. So, sir, my first question is, what could be the cost rationalization measures that we would have taken to sort of reduce our fixed cost?
Sorry, no, your voice is feeble. Can't hear you.
Buddhadev, if possible, can you take the phone off speaker, please, because your voice is going in and out.
Just a minute. Yeah, is this better?
Yes, sir.
Yes.
Yeah.
Yeah, sir. So what would be the cost rationalization measures that we would have taken to sort of reduce our fixed cost in FY21? I believe there were a lot of spends in terms of IT infrastructure, which we would have done in the last couple of years. So just wanted to have a sense in terms of what could be the cost rationalization measures in 21.
We have taken across the board a lot of things. We have looked at, sort of frozen manpower recruitment for some time. We have looked at the advertisement, selling, marketing, and even some of the IT spends can wait for a quarter or two. So as VG was trying to say that it depends upon the sales trend. And just to sum up, in terms of OPEX, we are aiming at a level which is at or below the previous year, which is FY19. And we have improved, and we have a robust proactive control mechanism now to deal with the OPEX cost in a much better manner.
Okay. Secondly, at the portfolio level, is it fair to assume that the average realization in FY21 could be higher as compared to FY20, given that the growth you highlighted in the athleisure segment has been very strong? Also, the
Yes.
segment is doing well. So, just your sense on
Yes,
that.
you're absolutely right. We have witnessed a very serious increase on realization per piece cost in the first 2 months. So yes, that's bound to happen.
Okay, and does that flow at the margin level also? Meaning, as a portfolio, would athleisure have a much higher margin as compared to your innerwear portfolio?
No, I see, as you know that we all these years we have been working on a margin level which is at the aggregate level, or which is at the overall level. There will be some products within innerwear or outerwear which could be upwards of 20%, and there could be some which would be lower. But overall, we work out on the average of the 21 to 22% EBITDA, which will continue to happen.
Okay, sir. Thank you very much.
Thank you. The next question is from the line of Vinod Bansal from Franklin Templeton. Please go ahead.
Hi, am I audible?
Yes, you are.
Thank you. So could you break down your sales of the March quarter, the growth numbers into Jan, Feb, and March, so that we have a better sense of how the quarter was before COVID?
I'm not sure about handy. Casey, would you have that handy?
We can take it offline, but though we don't sort of publish it, but we can give you...
I know, because these are unusual times. Even broad numbers would do for now. If you have some sense on how Jan, Feb was, the broad numbers would be fine.
I think we can answer you a little later. So we can move to the next question.
Sure. Okay. Also, I'm looking at the margins now. Gross profit margin, as you report, based on sales, were 541 crores less the cost of goods sold, raw material purchase, etc., and change in inventory. That declined to 58.8% from 63.6% same quarter last year, a drop of 5 percentage points almost. What's causing that?
Typically, when the sales is lower than the production, then the absorption of fixed cost varies from quarter to quarter. On a full year basis, we are pretty okay. So, for example, in terms of the Q4 itself, right, the sales was almost equal to the production. In the previous year, the production was higher, so it had a better absorption. But when we look at gross profit, we typically look at the material, the direct labor, and the direct factory overhead. That stays nearly the same at 39% throughout the past several quarters and years.
No, I understand. But, in the way you have reported to these exchanges, all of those factory overheads come in other expenses. And therefore, I'm comparing gross profit as revenue from operations minus cost of raw material, minus the purchase of traded goods, minus change of inventory. That number has fallen. That does not include the unabsorbed fixed overheads. That is simply input costs and output prices. That difference, the margin has fallen by almost 40%.
It's not the way to read the material cost, because the material cost is based upon the standard. And if the production, for example, in the same period in the Q4FY20, the production was 122% of sales. In Q4 of this year, FY20, it is only 113%. So there is definitely a difference in absorption, because in FG, all the labor, everything is combined and it is recovered from the, when we say material cost, it is the cost of producing goods. So when you look at GP as a whole, which is material, labor and factory overhead, then the absorption issue gets nullified. And that is what we typically say, that the gross margins are near are stable at 39%.
Okay. You mean there's more loading of per unit items in terms of cost structure?
Exactly.
Okay. Can I ask one more question? Is that
Mr. Bansal? Sir, request you to rejoin the queue, please, for any follow-up.
Okay. Thank you.
Thank you. The next question is from the line of Manas Visha from ICICI Prudential Mutual Fund. Please go ahead.
Yeah, thanks for taking the question. So could you give a sense on how the labor is, because we've been hearing a lot of migrant labor issues, etc. So how is that part of the business doing? And also there were reports...
Sorry, your voice is very feeble.
Is it better now?
Yes, please.
Yes. So one was on the labor, are you facing any labor shortage issues, etc.? And also second, there have been reports in the past that, there have been some salary cuts, etc. that you've taken. Any comments on the same?
I thought I had answered this earlier. I'll repeat. No, there has been no salary cuts for anybody in the company. And as far as the labor, as I said, since we looked after them in the tough times, and we did not bench anybody, neither we reduced salary. They were more than eager to come back. We have 85% of the pre-COVID force, which is already working with us at this point of time. And they are all operational. We have 85% of the machines operational and producing.
Okay. And sir, second on your working capital, if I see your receivable days have actually come off sharply. Does this mean that the distributors no longer require your credit support? I mean, I understand ADS could be one reason for the same, but given this scenario, this looks like a very sharp decline.
The receivable is unusually low because of the what we only recognize sales on delivery, and we had undelivered and dispatched goods at the end of Q4. Regardless, the receivable days have also come down because when you are locked down on 23rd, the collections do come in. So our normal cycle is about 10-11 days. Towards maybe the quarter end billing, it may go up. So the 9 days... That
should have simultaneously reflected in the inventory, right? But inventory is also not moved up significantly. So, it has to sit somewhere in the balance sheet.
The working capital is good. We haven't really significantly reduced on, working capital days. Working capital days for FY20 on an average was 57 days of revenue. It was 60 days the previous year. So by and large, it has moved in sync. The only difference this quarter which you see is that because we didn't sell or invoice in the last week of March, so the collections which have to come in for earlier sales have come in. Inventory is more or less similar.
Okay, sure, sir. Thanks and all the best.
Thank you. The next question is from the line of Nikunj Doshi from Bay Capital. Please go ahead.
Yeah, thanks for the opportunity. Good evening. I just wanted to understand the...
Mr. Doshi?
Yeah.
Sir, can you speak closer to the handset, please? Your voice is breaking up.
Yeah. Hello, can you hear?
Yes, sir.
Yes, please.
Yeah, so just wanted to understand the consumer buying pattern right now. Are you seeing any downtrading happening in the market or within your product categories or overall in the market regarding the innerwears?
No, not actually. In fact, as I said, the response has been, overwhelming. It has passed our expectations as of now. And we have not felt any downtrading because, as you also told, because of the higher number of the athleisure range being sold. In fact, our per piece average has gone up significantly during this time. And even if we take our innerwear separately, it's more or less the same what it was in the pre-COVID era. So not much of change we have noticed.
Okay. And vendors side, are you facing any problems in terms of supplies or manpower availability over there?
Not much. Yes, there are some small vendors where we have. But what we also have done in this meantime is we also have worked closely with a lot of other smaller vendors, and so it is. There are some small disruptions on the where we have this vendor base was smaller, but now it's more or less they're also coming back to track, and we had some initially when we just started. For a couple of weeks, we felt some small issues, but now more or less all our vendor base is intact and raring to go.
Okay. Thank you very much. Thank you.
You're welcome.
Thank you. The next question is from the line of Avi Mehta from IIFL. Please go ahead.
Hi, sir. I just wanted to clarify one bit that you said. Given the healthy recovery, did you argue that the EBITDA margin could possibly move back to the 21-22% levels for the next 6 to 9 months?
See, that's always the endeavor, and we'll do whatever it takes to be in that levels because that's the language we understand.
No, sir. I mean, where I was coming from is the recovery seems to be quite, optimistic. Your realizations seem to be kind of moving upwards. All of the news is kind of very heartening, so which is why I was just wanted to confirm that.
Yes, of course. That's our endeavor, and we'll definitely work towards that.
Okay, sir. The last bit was on the volume growth rate thing. If you could share what is the volume decline or growth for the year and for the fourth quarter?
Just a sec. I already said that. So we had a volume growth. So volume declined by 3% for the financial year, and 18.7% for the quarter.
Okay. Thank you.
Thank you. The next question is from the line of Utkarsh Maheshwari from Reliance General Insurance. Please go ahead.
Hello, can you hear me, sir?
Yes, we can hear you, Utkarsh. Please go ahead.
Just want to get ask about the margin.
Mr. Maheshwari, your voice is breaking up. Can you move to a better reception area?
Yeah. So in the current quarter, the reported EBITDA at 10% is actually a basic impact from that loss of sales which has happened, or is there something exceptional cost of loss is also there in the production side?
No, there's no issue on the production side. It was pure loss of revenue because of not having the full month. Because while the lockdown was in the last week, but actually the murmurs were almost from the first week of March itself, and there was a slowdown in the market in the entire month of March, and then last 10 days it was completely closed. So it was more from the revenue front, nothing to do with production.
Okay, so the economic sales have not booked because of that.
Sorry, I am not able. Your it's muffled. I couldn't hear anything.
So because of the decline in sales only, the margin has come at such a level. Otherwise, it would have been at 16-18% range what we were done last quarter, right?
Probably yes. Yeah, maybe even more. It had we completed our agenda of what we had planned to close the year on.
Just the last, as we have seen is that for home is something.
Mr. Maheshwari,
yeah.
So we are very sorry, but we are unable to hear you. Your voice is breaking up a lot. Can you move to a better reception area where we can hear you very well?
Yeah. That was it. Just want to understand what pointed out that there has been some improvement in realization because of the change of thought process in the form of work from home and all for the people by and large. So do we see that this can also translate to some sort of upgrading in certain pockets of the we have for the people by and large? Just improving that from the normal to the better category of boxes and all, printed ones and all. Do we see that as a trend and all?
See, there are a couple of things which are happening right now. One is that what we are observing is that the work from home culture, as I said earlier, has resulted in a significant increase in for the loungewear and the leisure wear and the boxer shorts requirements. The consumer trend to shop for entire family at one destination also is sort of something which we have been observing. And there's a huge demand on the neighborhood stores and the standalone stores, or the MBOs, if we call them, because they're closer and you don't have to go very far, and there are not many people around there. So all these things are only helping the cause for us.
Okay, fair enough. Thanks a lot.
Yeah.
Thank you. The next question is from the line of Manish Podar from Nippon India. Please go ahead.
Yeah. Hi, sir. Just wanted to get some sense on this comment you are saying that things are better than expectation. So what do you actually infer by that? So let's say your expectation was 25-30% sales coming back to towards the base, and it was better than that, or it was 50-60% and it is better than that. How do I infer that statement as?
Yeah, I know, Manish. Unfortunately, I can't talk in percentages or numbers for forward the numbers. But as I said, that of course, we also have plans for the year. So it's the whatever we had envisaged to happen in the first quarter, it has surpassed. So I'm sorry, but I may not be able to give you numbers or percentages.
Okay, and one another thing then, if I look at your staff cost and other expenses, now on this, India's basis, they're roughly about 1,100 odd crores, for the full year FY20. You mentioned a statement that you expect the OPEX level to be below F20 levels. Is that the right statement? And, is there a number to it because you haven't taken any salary cuts?
No, we have clearly said that overall OPEX will be, we're aiming to be below FY20. And that is, as we speak now, it is a plan. And I also mentioned that things will depend upon the sales trends. If sales is really picking up in the coming quarters, then we will have to adequately fund that kind of revenues.
No, because if I look at it and if I look at, there are two components, salary and the other expenses, and the other expenses, the larger part are the two variables, subcontract and the ad spends. So if I look at it, there's not material cost reduction which you can incur up here. So is that a fair assumption that, your OPEX level will be largely similar to what it was in FY20?
It will be similar, significantly lower than FY20, but there are some committed costs like salaries and all that. So that will continue to happen. But there are other large opportunities in the overhead which we have looked at, and we have quite a granular, proactive approach to keeping it on check.
Okay, fine. Thanks.
Thank you. The next question is from the line of Sangameshwar Iyer from Consilium Investments. Please go ahead.
Yeah, hi. A couple of questions. First, do you see given the post-COVID period where most of the competitors might see the pain of the lockdown, etc., and thereby weakening of balance sheet could reduce the competitive scenario? Could you comment on that as to how one should look at this industry incrementally going forward from a competitive scenario perspective?
Yes,
Are you taking that, Casey? Please go
ahead. We have a strong balance sheet, which is net debt-free, and we have always consistently been delivering also a return of capital employed this year, 55%, and then we've always been in around the mid-60s. So if you are hinting that are we going to throw in more credit and in terms of dilute the quality of sales and all that, that is not something which we would do.
No. What I meant was, given that now the competitors would be in a much weaker footing as compared to what we have with respect to a strong balance sheet, etc. Would that kind of translate into more and more vendors migrating more towards us, given the surety and consistency in terms of supply and delivery, as compared to the earlier days when there were more incentives which are being given by competition to kind of lure vendors away from it?
It's a good observation, but I will leave it to Vijay to answer that.
See, Sarmesh, of course, for sure that a strong balance sheet, a strong supply chain is going to make difference. It's not only for us, for any industry as such. And luckily, I would say yes, we have, those are strong points for, both these are strong points for Page at this point of time. And we'll make full use of that for sure.
Got it. And so as a follow-up to that, past 2 years we have seen many of our segments on the innerwear kind of seeing volume decline as we migrated to the premium segment. Do we see volume slowly coming back, or the decline kind of getting arrested now, thereby resulting in both the benefit of value and volume getting accrued to your revenue as the product improves?
In fact, Sanmesh, on the contrary, within the innerwear segment, the ones which were the premium and the super premium were growing the fastest for us, even during the last year before the COVID hit us. So I'm not sure whether you were aware of that.
No, I was aware, which is why your realization was improving and thereby contributing to your revenue growth. However, it was not the full benefit of realization improvement reflecting in your revenue growth because of volumes declining. So I was more alluding to that part where the full benefit of this change in product mix by flowing through to your resultant revenue growth. That was what more I was looking at.
It's a little difficult to comment in these circumstances on that. But whatever understanding we have from this 1.5 month of sale, we have not seen any significant changes in our, except for the loungewear, which has, as I said earlier, has almost gone up by 7% higher than what it used to contribute as a percentage of category mix. Besides that, within the categories, we have not seen a huge change happening. Though it's a very small time factor for to create a conclusion from here, but that's what we have observed.
Okay, so maybe then as a follow-up, just to understand, this athleisure is a segment where you primarily see the larger sports brand having a larger market share, and then followed up by us, and even now Decathlon to a certain extent. Do we see that because of the kind of economic scenario that many of individuals are facing in India, we could actually see a large pickup or a strong push for our brands, which is in the aspirational segment, but in the midway between the price points of Adidas or Pumas or Essex and others in the segment?
See, that's the performance side of the business you're talking about, right?
Right.
We have a segment which is called the move range, which falls into that category of performance. Besides that, we have a very huge range in both tops and bottoms, and even now summer and winter, which is jackets and sweatshirts and a lot of stuff which is not on the performance side. So the performance side is more closer to the brands which are more sporty brands, and the rest is more casual and loungewear. That is the chunk which is growing very fast for obvious reason, because the choice of apparel has changed. So it's not that we are sort of competing within the industry here. I think it is actually taking the pie or the share from the casual wear or from the formal wear, because that's no more in demand at this time. So the athlete is taking a large chunk from that pie.
Got it. Thank you. I'll come back.
Thank you. The next question is from the line of Bharti Sahu from Asset. Please go ahead.
Thank you for taking my question. So one question on the gross margins. In the press release, you've mentioned that your gross margins have been steady and strong at 39.3% for the financial year 20. So is it fair to assume that your FY19 gross margins were also at similar levels?
FY19 was around 39. And even if you go back in history, FY18 was about 39, 38.7, and FY17 was 37. And across the quarters also between the band of about 39% is consistent.
So my question is that if I just do rough math, our fixed costs, other than the direct expenses which are attributed to the products, our fixed cost base has actually gone up by 170 crores despite of just a 3% increase in the sales and overall degrowth in the volumes. So can you just explain this 170 crore increase in our fixed cost base? What is that attributed to, and how much would this and how much of this fixed cost base would be A&P spends, and what would be the increase in the A&P spends for the year?
Come again. What did you say? The last one I didn't get.
So first of all, I would like to understand, so if I just do the rough math of 39% and 39.6%.
The last part.
Last question is, what is the increase in the A&P spends and what is the absolute A&P spends during the year?
You're talking about
A&P,
yeah.
advertisement. Yeah.
Okay. No, in terms of fixed cost, we don't. This year we didn't get the kind of revenue growth, particularly due to Q4. We have mentioned it many times. Now the question is that these are all investments mainly, as we have mentioned on the call earlier, in sales, particularly the jockey juniors. We have senior people in the sales management who have joined us. Similarly, we have invested in IT projects significantly in FY20. So these are the big reasons for the cost increase.
Any cost which is non-recurring in nature, like your investments in IT. So is it more OPEX-led, or that is kind of one-time investment that we have made and should not be recurring in future?
IT will be a one-time investment. Similarly, some of the business transformation projects which we have done with Deloitte is a non-recurring expenditure.
So how much of the cost would be non-recurring in nature?
That would be hard to quantify right now, but we can take this offline.
Okay. And so one, yeah?
I'm sorry to interrupt, but for any follow-up, request you to rejoin the queue, please.
No.
Thank you. The next question is from the line of Resham Jain from DSP Investment Managers. Please go ahead.
Yeah, hi. So I have a question on the sales incentive or the yearly targets which you typically give to the distributors. I presume that because of the last 10 days of disruption, those yearly targets might not have been reached by the distributor, and because of that, possibly the incentives, the additional incentive which we give them, might not have been achieved. So, any comments on the same, especially with respect to the provision being made for the same?
I think this is a purely operational question. I don't think I would like to sort of reply this question.
Okay, fine. So I just wanted to understand, just from the provision perspective, whether it is going to be accounted for FY20 or FY21. That's what.
So no, that's an obvious accounting procedure. If anything which was due in the financial year was not paid, that has to be provisioned, right? So there's no other thought on
that has been made. Okay.
Yeah, the short answer to this question is, we typically the schemes are between 3 and 4% of revenue. It all depends upon the schemes we are running, the categories, the geography. And to your question, that all the schemes and which ran and related to the sales prior to March have all been accrued in the FY20 books.
Okay. And so my second question is, you mentioned that manufacturing is now back to 85% of the normal situation. So should one assume that your manufacturing operation and the sales should go hand in hand?
No, I can't say that because that again implies futuristic outlook. There is a lot to do with the efficiency of those 85% people. What's the number of pieces we produce? We also have something which is we buy from FOB. So it's a mixture of fixed few things. So sale cannot be directly correlated with the kind of manufacturing we have in-house, because in-house is a percentage of our overall number, right? Overall production number. So I don't think we can take a sort of and take a clue from there and assume the sales.
Okay. Thank you, sir. Thank you. That's all.
Thank you. The next question is from the line Agarwal from ICICI Securities. Please go ahead.
Hi, sir. Just one question. In terms of the strategy, now we had a lot of initiatives that we were working on, right, in terms of investments in the R&D, in the sales and marketing side, the auto replenishment system that we were working on at the distributor level. So just want to get your thoughts on the kind of prioritization that you would do. And this question is more in terms of after, say, the 9 months when things normalize, when we're back to the pre-COVID levels. So do we still continue with these investments? Do we take a break and, sort of delay it for some time? So your thoughts on that, please.
There are a few things which KC has already clarified in terms of IT infra. We have sort of halted it for some time. Business transformation is almost over, so there are no investments required on that side. As far as ARS is concerned, there is no investment as such, in the ARS. We already have the system in place. It's a question of getting the product mix right, and then having the assortment mix there for the distributors to start ordering from that mix. So it's more of a mix of manual effort to put it together, which we are continuing even during this time. There was a short period when we did not go through the ERS route for billing, but now we are back on ERS, and we are also working. The team is again aggressively working towards getting the new partners into the ARS fold, because we think that's the most that's the best way to go forward, especially in these times, to have the right stock with all our channel partners.
Understood, sir. That's helpful. And so just one more thing. So in terms of the price hike, so we generally tend to take the 3 to 5% price hikes every year. So does that change this year given the kind of circumstances, or do we continue? Any thoughts on that as well, please?
We have not taken a call on that as yet. We will very closely monitor the situation, and we'll take an appropriate call which is good for the business.
Sure, sir. Got it. Thank you so much. That's it from me.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I now hand the conference over to Mr. Chandrasekhar for closing comments. Over to you, sir.
Yeah, thank you very much. I just missed answering one of these questions on the advertisement. So for FY19, it was around 120 crore, and in FY20, it was about 115. So more or less similar, because we normally operate on a percentage of revenue, as also depending on the ATL, BTL, which we want to do. So thank you very much for joining on the call. Hopefully we have answered all your questions, and you can still reach out to us via email or through investor relations, and we'll be happy to answer any further questions and doubts which you have. So with that, I conclude this earnings call of Page Industries.
Thank you very much. Ladies and gentlemen, on behalf of ICICI Securities Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.